Bismillah Rahman Rahim. Assalamu alaikum everyone. I am Hussain Qazi, the facilitator for ACCA, SBR exam, AFM exam and FM exams. Candidates, this video is actually about the discussion related to the current development or current issues of the SBR exam. This is actually a series of short videos to support you for the relevant exam of the SBR, that what current examine can examine by the examiner, and how you have to work accordingly. So whatever the series of videos, short series of videos, and the document I will share with you, you have to focus accordingly for the exams, upcoming exams, either for December 20 exam or March 21 or June 21. That's relevant for all. Examiner particular said, sorry, past exam analysis indicated that the exam scope, it's something about 8 to 10 marks, but it's not specific. And number one, ACCA published the document by June 20 and already mentioned that the scope of the current development areas in the SBR exam are these. So what's the scope? I have filtered out this scope accordingly. So don't prepare or don't go where no need to work out any other matter apart other than this list. So this is what the current development aspect. Number one, some exposure drafts. I will discuss one by one. 3 exposure drafts, 1 discussion paper, 2 practice statements, and the conceptual frameworks is current development, but I cannot say that, I must not say that conceptual framework, it's upcoming development. It's already established, the conceptual framework, the new conceptual framework, and it's a core syllabus area. It's a part of the syllabus areas. During the preparation, the tutor supported you to connect with different areas of the syllabus with a conceptual framework, and my students already have the document related to conceptual framework, so focus on that particular document of the conceptual framework. So candidates, you just need to watch my videos, and whatever the document I will share, you have to follow it. Don't go anywhere a part of this. This is good enough for your preparation, and inshallah ta'ala, examination scope under these material, no more than that. Before starting any particular topic, examiner has particular mention or guided you about the scope of exam. Above was the scope of syllabus. That is a scope of exam. So before examination, you must have to prepare your mind accordingly. These statements are examiner statements. SBR examiner defined scope about current development. Exam scope. Number one, examiner particularly mentioned that for any particular upcoming current issue, the examiner will, it's not expecting the detail inside. It's not expecting any detail inside, but just the principle you have to know. What their expectation that the candidates just know about the principle of the current development rather than detail inside. Number one. Yes, you must be able to explain or discuss the pitfall or deficiencies related to current issues, whatever the new development expecting, or other way around, I can say that if something going to replace, for example, a couple of years ago, there was a current development about to replace the leases from IAS 17 to IFRS 16. So examiner was expecting at that time that a student must have to know about the principle about what is going to change, that's IFRS 16. And also that what's the pitfalls or deficiencies in IAS 70. So if something going to replace, what's the pitfalls or deficiencies? And as I said earlier, that also about if examiner asks that, examiner can examine that. If something going new to happen, what do you think in new development, what deficiencies may arise or what pitfalls? Okay, examiner also mentioned that there will not be a complete question of section A or B. I mean section A 30 and 20, section B 25, 25. So it's not possible to examine one complete question about it. So don't worry about it. Huh? Don't stretch, don't take too much stretch about this topic. Just get basic principle and make a practice how to write it. Examiner, there is, and even the last point, there is no fixed place at what section the examiner will examine. Examine anywhere. Examiner can examine anywhere in the question paper, either section A or B, but will not be a full question. Most likely to form part of another question. So it's more likely like, for example, let's suppose section A question 1 and last part 5 marks. For example, section B, one of the part. It's already examined in like that manner. So don't stress too much about it. You just get a overview about the topics, number 1. Number 2, furthermore, you have an ability about the principles and the pitfalls and deficiencies, and it's not about the complete questions. Okay, the first thing we are going to discuss now, and what's the first thing, candidates? The first topic I'm going to discuss here, it's very simple. Current development related to candidate deferred taxation. Related to deferred taxation. So number 1, deferred tax, and the name about that, exposure draft 2019. 5th exposure draft published in June 2020, 20th June 2020. And that is about deferred tax related to asset liability arising from the single transaction. 2 specific single transaction. This issue is about 2 specific single transaction. Okay. So what is the particular purpose for this exposure draft? What's the background? This exposure draft examinable document SBR from the September 2020 sittings. It was issued 2019 and seeks to make amendment IAS 12 income tax in order to enhance faithful representation conceptual framework. You must have to mention, if examiner mentioned that, why board need to change this. You have to mention that this is actually about enhance the faithful representation of accounting of deferred tax, and also designed to improve comparability of few reporting entities already account for deferred tax in this way. So this is what the background. Sir, tell me about that. What is this about? Actually, this proposed amendment is related to 2 specific topics. Deferred tax related to IFRS 16, right of use asset, and provision for decommissioning cost. That is IAS 37. So 2 specific items you need to work out accordingly. Candidates, from your studies, you know very well that before entering or before discussing a detailed insight or principle about these discussion, 2 things you have to recall from your regular studies. Number 1, a quick reminder of the deferred tax principle. You people know very well that deferred tax liability are recognized on all taxable temporary difference. On all taxable temporary difference. You know very well. It's mentioned that the principal IAS 12 income tax states that deferred tax liability recognize all taxable temporary differences when the carrying value of asset and liability and corresponding tax base. When there are difference between the carrying amount of asset and liability and the tax base, you have to book the deferred tax liability. That's about the taxable temporary difference. Only about the discussion focused on taxable temporary difference. The discussion not about the deductible temporary difference here. The discussion about taxable temporary difference first. Although you can incorporate deductible as well, no issue. Furthermore, accounting for deferred tax rooted in matching concept. What matching concept? Matching concept means if we are actually accruing some income, although not receive the cash, but accruing some income. So income credited to P&L. So the related tax must also be accounted for in the income statement. So that's called matching. Income match with tax. If amount not received but recognize the income, that's called the principle of accounting accrual. So if we have recognized the income, so we must have also recognized the tax related expense as well. So income match with expense. That is what the principle behind the deferred tax. That is the principle. A quick accounting for deferred tax rooted matching concept. Okay. For example, let's take an example. Let's take a quick example. For example, let's take an example. Deferred tax by balance sheet approach. Balance sheet, one of the asset that is land. For example, a company acquired the land 1st January 20 with the cost of 100,000. It's very simple. And the tax base same date 100,000. Accounting value 100,000 and the value according to tax 100,000. The difference is nil first day. But as the times goes on, for example, 31st December 2020, the company policy to revalue the amount. So revalued amount, for example, 1,50,000, let's suppose. But tax base is still same, 100,000. Still same. What the principle? The principle says that, tax authority says that you have revalued the asset on the basis that you have recognized the income. Although asset not yet disposed. But we will consider this gain once you will sell it. So there is a difference of 50,000 with, and this difference, I must say that the asset carrying amount exceed tax base is equal to taxable temporary difference. And let's say the tax rate 30%. So we have to book deferred tax liability 30%, let's suppose, of 50,000. That's equals to 15,000. So sir, we have to book the deferred tax liability. Sir, what about the principle of deferred tax? The deferred tax principle is that at one side we have booked land debit and equity revaluation reserve credit. That's 50,000. That's one side. That's we have booked the gain. On the other side, we have to book the deferred tax liability. Deferred tax liability credit and revaluation reserve debit, that's equals to 15,000. And that is what the principle that is called matching. Although land has not yet sold, but book the gain revaluation by IAS 16. So deferred tax says that you have to match the principle. Also book the deferred tax liability. That's the matching principle. This is what the principle of the deferred tax. And you can read accordingly. That's a matching. Till now, I haven't discussed anything about the current development. That is what the basic principle of the deferred tax you have to recall. Number one. And you can read accordingly. Now moving forward, before moving forward, one thing you must have to stick in your mind. Till now, we have recalled that for all taxable temporary difference, we have to book the deferred tax liability. But in IAS 12, there is an exception paragraph. There is an exception paragraph. And the exception paragraph is that by name of initial recognition, where the accounting standard 12 says that for all the taxable temporary difference, you have to book the deferred tax liability, and all deductible temporary difference, you have to book the deferred tax asset, except means if exception 3 condition meets, then we will not need to recognize the deferred tax. Accounting standard says temporary difference with no deferred tax. A deferred tax liability or asset should recognize for all taxable deductible temporary difference, unless means exception. They arise from number one, initial recognition of the asset liability transaction, which is not a business combination, group accounts, not a group accounts, and at the time of transaction, means at initial recognition, neither affect accounting nor affect taxable profit. That is your regular studies. If these 3 conditions meet, you don't need to recognize the deferred tax. What 3 exceptions? I'm sorry. What 3 exceptions condition? Number 1, if deferred tax arise at initial recognition, plus these 3 conditions must be of I, initial recognition, plus not a business combination, B, plus affect neither accounting nor taxable profit, IBP, initial recognition, not the business combination, plus not affect accounting and taxable profit at initial recognition. If all above exception criteria meets, no need to recognize deferred taxation. Okay. This is your regular studies. Still now, I haven't discussed the current development, but you have to recall it properly. Now, let's take an example about this. Now, take an example. Example of initial recognition of asset liability in a transaction which does not affect either accounting for taxable profit at the time transaction or means whatever we have discussed above. Now we are moving accordingly. For example, let's take an example. A depreciable non-current asset which attracts no tax allowance. A depreciable non-current asset but attracts no tax allowance means due to some reason tax depreciation is not allowed in this asset. Means in accounting we depreciate, but in tax authority they are not allowed the depreciation expense. due to any reason, due to government policy, any reason. It means it's a clear difference, but not temporarily. It's permanent difference. In this case, taxable profit never affected. And depreciation is only charged to accounting profit after the transaction. What accounting standard says that whenever you initially recognize this asset, for example, initial recognition, for example, you initially recognize 1st January 2020, initial recognize. This non-current asset initial recognize. Do remember initial recognition, we not charge the depreciation. Non-current asset accounting value, let's suppose 100,000. Tax base for any non-current asset, tax base is equal to future allowable expense. Means in future how much depreciation will allow. Ask yourself how much depreciation will allow. Here mention that government policy not allow tax allowance. That means tax base nil. So in this scenario, asset carrying amount exceed tax base is equal to difference, yes. Difference, yes. But we will not book the deferred tax. But why? Why we will not book the deferred tax? Because it's a permanent difference. We cannot book the deferred tax because it's not allowed in future. And the most important thing, it is because these three conditions now going to meet one by one. Is this difference arise at initial recognition? Ask yourself. Initial recognition means whenever asset record. Yes, initial recognition. Number one. First condition, initial recognition meets. Number two, plus. It's not a business combination, not a business combination. Yes. Plus, once you record the transaction, means non-current asset debit bank credit. Only at initial recognition, neither affect accounting nor taxable profit. It's not affected to accounting, not taxable profit. Not affect to the profit. That means exception meet is equal to exception meets and not to recognize the deferred tax. This is what your regular studies. But candidate, do remember, for example, 1st January 2020 date has gone. And very important thing, now you are standing at 31st December 2020. And you have depreciate the asset. For example, depreciate straight line, 10%. 10,000, for example, and your asset value become 90,000. That is the carrying amount. Your tax base is still nil. And there is also difference here, difference. But what you will say that although year end has happened, difference here, but you will say that we will not book deferred tax because at initial recognition, once this asset initially recognized, the exception criteria meets. Although, once again, 2021, 22, 23, every year difference arises, but you will not book. And also always refer if each year end, after 2 year, 3 year, 4 year, 5 year, you will refer that we will not book the deferred tax because that meets the condition of exception at initial recognition. I hope you people are getting the point. This is what your regular aspect. And the very important point, each year you charge the depreciation expense. Depreciation expense to accounting profit, and it become reduced. And tax profit, no effect. So as compared to accounting profit, tax profit higher. And you will say that there is a difference between accounting and tax profit. But you will never book the deferred tax because it's meet the initial recognition. So you must have to focus this point that for all taxable, deductible, temporary difference, you have to book the deferred tax, either liability, either asset. Taxable, temporary different, deferred tax liability, deductible, temporary different, deferred tax asset. But if it arises at initial recognition and meets the exception criteria of initial recognition not affect, not the business combination and not affect at initial recognition, accounting and tax profit, we should not book the deferred tax. Now, what's the issue? The problem, the case one. This is what is the actual exposure draft. What's the problem? What's the issue? What's the issue? There are two specific issues. Number one, right of use asset. Lessee accounting. You must have to recall your mind. Lessee accounting. Once the lessee lease the asset and meets the IFRS 16 contract criteria, and it's not the short dated and low value assets, lessee must have to report the asset as a right of use asset and simultaneously lease obligation, debit, credit. And one important thing, right of use asset is the asset that's by IFRS 16 according to IFRS 16 according to accounting principle. But it's not the asset legally owned by the company. So that's why tax authorities will not consider this asset as an asset or not allowed the depreciation in future because it's not legally an asset. I repeat, right of use asset, it's substance, economic reality, accounting principle asset. It's not the legally. We don't own the asset. Lessee don't own the asset. That's why tax authority says that if you don't own the asset, we are not considering the right of use asset as an asset. So if the tax authority not considering the asset, right of use asset as an asset, so no depreciation will allow in future. That's an important point. Another important point. Each year accounting, the related right of use asset depreciate. The related lease obligation, finance cost, charged to accounting profit. Each year, right of use asset depreciation, lease obligation, finance cost, but not to the tax expense. But it's not tax allowable expense. If tax authority not accept asset, so definitely it's not accept the liability. If it's not accept the asset, so no allowed the depreciation, no allowed the finance cost. But whatever the rental we pay, whatever the each year with rental we pay, tax authority will provide the relief, the actual lease rental. Tax authority allow lease rental as a tax relief. So this means in the as accounting and tax, if you are comparing the accounting and tax, in accounting, we are we are charging the depreciation and finance cost, and tax lease rental. Do remember, for example, if there is a time period of 10 years lease, at the end of 10th year, if we totaling the depreciation finance cost and compare with the total lease rental, both are equal. Both are equal. So this means that right of use asset is actually a timing difference, temporal difference. And we have to book the deferred tax. Because one accounting, we are booking expense with different name called depreciation finance cost. In the tax, we are booking different. That's called lease rental expense. So this paragraph is important. The above case apparently shows to develop a deferred tax based on temporary difference. Based on definite difference. You have to accept it. This is the temporary difference, accounting and tax. But the eye-opening thing is that exception criteria also meets. And if exception criteria meets, which means that no need to book the deferred tax. Huh? What is going on? There's a conflict. If we are booking the right of use asset, listen here. For example, if lessee books the right of use asset with the accounting value 1 lakh, what about the future allowable expense? Nil. What's the difference? Yes, difference arise when initial recognition, at initial recognition. So all three conditions going to meet. Yes, initial recognition, not the business combination. At initial recognition, not affect the accounting profit, not affect the tax profit. Means exception meet. And exception meet means at this point and subsequently, no need to book the deferred tax. This is the conflict. And that there is a proposal about the issue. That's one, at one point you are booking the asset. Another point, you are not booking the deferred tax as per the rule. And this, there is no application of matching concept. This is a flaw. So candidates, that is what the issue, that's the issue I have shared with you. This is what the issue. The problem that arises, that's issue. Now what's the solution they are proposing? That's the exposure draft. Consequently, the board is proposing amendment to the exception. Means, listen carefully. For all taxable temporary difference, you have to book the deferred tax liability, number one. Number two, but initial recognition exception meet, then no need to book. Now third is in exception, there is exception. In exception, there is exception. Means although right of use asset meets the exception criteria, but you don't need to consider exception, and you have to book the deferred tax liability. That is the wording. Consequently, the board is proposing amendment to the exception, and so required reporting entities to recognize deferred tax temporary differences arising on right of use asset, lease assets. They are proposing to. That you don't need to obey the exception criteria and book the deferred tax liability. Such a change is welcome, follows the spirit of IAS 12, enhance the faithful representation of the way the tax is reported. If in exam, it's going to exam, it's if the examiner examined this point, number one, you just know the basic principle of deferred tax, basic principle of exception, basic issue that right of use asset not meeting the principle of exceptions. What the pitfalls? You have to mention that the pitfall is that, or deficiency right now in IAS 12 is that they are not actually meeting the matching concept. Although this is a temporary difference, that's one side depreciation and finance costs, tax side lease rental, but we don't, that's a temporary difference, but right now we are not booking the deferred tax. So examiner can examine it accordingly. Another one, another problem, last 5 minutes, another problem. The problem that arises, provision for decommissioning. Number one, what's the accounting? First of all, think about the accounting. Provision for decommissioning, that's for example, you have purchased some asset. The life of the asset is 10 years. And you have legal obligation or the constructive obligation to decommission the asset. Restore the thing and decommission the asset. So you have, once you install the asset, you have to book the provision. You have established a provision of as per IAS 37. Although I haven't paid, but book the provision on present value basis. And subsequently, unwinding of discount. You have booked the asset, you have to expense out at the finance cost. And furthermore, you have booked the asset and that provision is a part of asset. An asset over the period depreciate. So in accounting, it's expense by depreciation, it's expense by finance cost. Finance cost, depreciation, that's expense. You are expensing. But tax authority say that we will allow the expense on payment basis. So they will allow, but payment basis. So there is a difference. That tax will allow expense once paid, but we are here to capitalize the asset and expense out and finance costs unwinding. So actually this is what temporary difference. Temporary difference. The above case apparently shows to develop the deferred tax based on temporary difference. But temporary difference have to book the deferred tax. But once again, same issue here. Also meets exception criteria. Here not the case about right of use asset, that's provision decommissioning. Accounting value. Accounting value, for example, 100,000 provision. And you have to capitalize with asset. Tax base, carrying amount less future allowable expense, nil. Yes, difference 100,000. Number one, at initial recognition, yes. Not a business combination, no. Once recognized, not affect the accounting profit. How it's possible not to recognize the accounting profit? Because it's capitalized with the asset. Okay, not to the tax profit. So that means exception criteria meets. So no need to book the deferred tax now and subsequently. No need to book. But here, this is the temporary difference. That's the issue. Again, no application of matching concept. What's the solution? Proposed solution. These are proposed solution. the board is proposing amendment to exception and required reporting entity to recognize deferred tax on temporary difference arise. Such change is welcome and follows the spirit of IAS 12 and enhance the faithful representation the tax is reported. Once again, you have to know about the basic principles of this proposal and the pitfalls of or deficiency of existing IAS 12. So candidates, that is what the first part of the current development aspects. Examiner can examine. It may possible that in section A, section B, section C, anywhere, some part of the question related to this issue. So that is what about the current development related to deferred tax. That's important for December 20, March 21 and June 21 exam. Thank you very much. Take care a lot and still tune with my YouTube channel or our Facebook page. Thank you very much. Take care a lot. Assalamu alaikum.